Good evening. Welcome to the big question on NDTV Profit. I'm Vikram. So what's happening in the primary markets of Dalal Street? Now what is happening over there, it could well be mistaken for a gold rush, but it's not for gold. We're talking about the IPO market. Suddenly the hottest ticket in town, nearly 45,000 crore rupees worth of public issues set to hit the street this month itself. And consider Tata Capital, you can consider LG Electronics India. These two alone headline this mega lineup, which is almost worth 30,000 crore rupees this week itself. So the unlisted market already buzzing with all those hefty premiums. The FIIs, they seem to be tiptoeing back. They're rubbing their hands in glee a little bit, and retail investors are joining the party with fresh enthusiasm. But haven't we seen this story before? Euphoric listings that do not quite live up to the debut day dazzle. How different is it this time? What is different this time? Can these marquee IPOs really turn the tide and spark a new bull run on Dalal Street this Diwali? Or are investors getting carried away on sentiment, on liquidity? That's the big question. With our panelists, our research team also joining us, we are here to debate if India's IPO boom is building the next rally, or is it going to be just the latest reality check? And joining us tonight to break down the big question on IPOs is Devina Mehra, the founder and chairperson and managing director at First Global. Pranav Haldia also with us, managing director at Prime Database. Great to have you both with us. Devina, let me ask you first. Nearly 45,000 crore rupees of IPOs lined up this month itself. What does it seem to you? This IPO frenzy that we are constantly talking about, some call it hype, some something else. But tell us what you make of this kind of frenzy. Where does it actually come from?
Oh, hi, Vikram, and greetings to your viewers also. But as far as the IPO frenzy is concerned, I saw a headline saying that this has come after 3 decades. And I was there 3 decades ago also. And there were years in the 1990s when there were 1,200 listings and 1,300 listings. And so my advice to retail investors would be that when there is this frenzy in the IPO market, usually it makes sense to keep away. And the reason is very simple, that in the frenzy, normally issues tend to be overpriced. And the issue which has a decent business and is reasonably priced, you are unlikely to get allotment. So it's a very simple mathematics. People look at the IPO listing pop, and SEBI data shows that something like 60-70% of the individual investors get out within a week or two of the IPO listing if it lists at a premium. So those are that shows me that they're not really even valuing the business or investing in a business. So they think it is some kind of lottery. And let me also remind your viewers that there is only one way to value a company, whether it's an already listed stock or it is an IPO. So there are no different ways to value IPO. And sometimes, especially in new type of businesses, someone will come and tell you the story that don't look at the normal valuation parameters or don't look at cash flows, look at this XYZ thing. And that normally is a trap because they're trying to justify a valuation, not get to a valuation. This is compared to the 90s. One thing which has changed is that a lot of the issues, the money is not even going to the company. A very large chunk becomes offered for sale, which that means it's an exit for existing shareholders. So you are buying at a price at which either the promoter group or so-called more sophisticated investors are exiting. So never forget that either.
But there is that element, yes, in your recent tweet. And of course, let me welcome Dhananjay Sinha as well. He's joining us from Systematic. Great to have you on board for this debate as well. But Devina, on your point, that tweet that you put out, I was reading, you're saying that IPO booms often lead to overpricing, and those seem to benefit only issuing companies. You're saying that now as well. Existing shareholders also perhaps, but more than investors who put in that hard-earned money into IPOs. So are you saying that retail investors should stay away? Has anything changed in the last 3 decades that you've been seeing IPOs in the market? You told me what has changed, but is it significant enough for us to change our tactic towards IPOs? Because like you're saying, there is money to make, but it's not for the small investor.
I'm saying that when there are IPOs that come when the IPO market is at the normal level, then you might get something worth buying.
Okay.
But when there is a frenzy, normally it is prudent to keep out of the frenzy. And as I said, from 3 decades ago, earlier all the proceeds used to go to the company. Now it is not existing shareholders only, it is exiting shareholders. So there are
Right.
people who have bought earlier who are exiting. And
Right.
that really also, so your money is not even going to the company in many cases, or substantially not going to the company. So that is a issue that you have to keep in mind. You can't forget that. But as I said, people are
Yes.
not even looking at how is this money getting used? Is this
Exactly. But
business
because
worth
they are
it or
looking at
not? They
listing
think it's a
gains.
lottery.
Maybe
They think
because they think it's a lottery, listing gains is something that they're banking on. Pranav Haldia, what do you say? You look at this surge in IPOs, you think it's confidence in the valuations that's driving issuers to put them out there? Is this the rush to list before we get struck by higher volatility again? Because it's one side on the issuer side, but the investors right now, and that's what Devina is saying, not much gains over there, especially if you buy into a frenzy as sometimes it's hype.
Well, good evening and thank you for having me. So, a couple of points. One is that we have to remember that IPO market always follows the secondary market, and you can look at the data for the last 40 years, and whenever you have bullish or slightly stable secondary market, you see a surge in IPOs. Now, this time, of course, the numbers are far higher. The number of filings, we just put out a study that it's at a three-decade high. There are a whole set of reasons behind that, and valuation is of course one, because the valuation which promoters are getting in the public markets are extremely attractive for them. The other key reason which I see now is that a lot of traditional Indian family businesses, which used to be closely held and not very willing to dilute equity, are now actually seeing the power of net worth creation on the back of some of the recent IPOs that you've had. And this is especially playing out in Class B, Class C cities, where you're finding small companies going for an IPO. The promoter's net worth has gone into thousands of crores, and that's had a tremendous rub-on effect. The second category of companies which you're obviously seeing are, the private equity-backed companies. And to put this in context, of course, the private equity ecosystem is now about 20, 25 years old in India. And you're seeing a lot of their investments over the last 10 years have been exited through the public markets. To that, and also alluding to the point which we were just discussing about the money going to selling shareholders or to the company. And Ms. Mehra had mentioned about the 90s. But we also need to remember that in the 90s and even early 2000s, a lot of companies which raised only fresh capital or predominantly raised fresh capital either vanished away with investors' money or the business model did not pan out. So the way I see it is that the capital market ecosystem in India has really evolved. That the early stage risk capital is actually now being provided by angel investors, venture capital, and private equity investors. And only when companies reach a certain stage, a certain scale, have some governance mechanisms in place, do they come to the public market.
So
So I
you're
think
saying,
is that you now see, and one final point is actually pulled out some data, very interesting data, that from January 2015 onward, which is roughly about 10 and a half years, there have been 103 pure OFS IPOs, which are 100% OFS. On an average, they've given a return of 351% till date, while the 81 pure fresh capital IPOs have only given a return of 202%. And the ones which are mixed have given a return of 170%. So even if one were to look at the current price performance of
yes.
pure OFS IPOs, the data shows otherwise. So I think investing into an IPO, instead of looking at whether the money is going to the company or to the investors, I think an IPO investment is fundamentally about two things: the quality of the company and the valuation at which it's coming.
And
So
you
quality,
think this is a good time? You believe that this is a good time for small investors to park money in an IPO for listing gains or to stay there for the long term?
well, there is never a good time or a bad time for a good investment. I think, instead of generalizing, I feel every single IPO needs to be looked at its own merit.
Okay.
Unfortunately, a lot of individual investors, especially, and as Ms. Mehra was saying, the SEBI study also showed this, that a lot of individual investors are only looking at IPOs from a listing gain point of view.
And there's nothing wrong with that.
As long-term investors.
All right, fair enough. Dhananjay Sinha, what's your take? We are seeing hefty premiums in the unlisted space. both on Tata Capital, on LG India as well. How much is this driven by fundamentals, according to you? And how much do you think is about the current sentiment, catching the momentum, having that FOMO for small investors? How much is it about liquidity, you think?
Yeah, so I think, it's a mix of things. So if you look at the broader context, there is a considerable amount of, fundraising that has happened through IPOs. If you look at the flagship IPOs or even the SME IPOs, the overall fundraise has been quite significant this year, almost like $9 billion. So it's a significant rise over last year. And I think the whole thing is all about the market situation. I think Pranav was talking about the buoyancy in the market, and that's a time when you see cyclical buoyancy in the IPO launches and listing as well. So I think whenever the market dries up, things get postponed, and then it suddenly surges when the market sentiment improves. So I think it is about the valuation. A lot of the OFS thing is happening. A limited amount of money is going into capital formation. So that is definitely happening. And essentially, the retail participation has been quite significant. We have seen that FPI participation over the years has been sort of moderating. So I think retail investors are providing exit, as Pranav talked about it. So I think that is an important thing. I would say we need to really differentiate between the IPOs, which are genuine, the companies that offer something on the table are something that are actually creating value for the investors. But I would say a large part of it is essentially aligned with the market valuation. And if you look at the market cap to GDP, as Pranav was saying, the correlation with the overall market valuation reflects on the IPO market as well. So if you look at the overall valuation from an overall context, it is about 125% of GDP if you look at the NSE market capitalization. This is compared to 80% in 2019, for instance. So there is a considerable expansion that has happened. And we also know that from the SEBI survey that roughly about 6% guys are actually active in the market and 9% actually participating, which means that a lot of valuations are driven by a select segment of the investor. So for retail investor to really make money, that 6.5% market household proportion needs to expand on a perpetual basis. So at the current valuation, the current valuation is like almost double that of China.
Correct.
For instance, that 55%. So unless the overall pie increases and the holding in the household continues to rise, it is quite likely that a lot of these things can actually end up making capital losses. And we know from the SEBI survey also that almost like 85% of people want to conserve capital. So we need to be very careful about which are the companies which are investing in businesses which can create value, leaving money on the table, and a substantial people which are actually exiting at high valuation. So that is something that needs to be looked at very carefully.
Devina, when you were kind of hearing out both Dhananjay and Pranav about this, another market veteran, of course, Vikas Khemani, had joined us earlier on NDTV Profit, and he was talking to us about Tata Capital's strong fundamentals, like he called it, ahead of its IPO. And I wanted to ask you if you think retail investors are fully pricing in the kind of strength that some of our market veterans have been pointing out, or do you still believe that it's about hype and liquidity? Now let's talk specifics. Do you think valuations are getting distorted anywhere?
Okay, so let me first address what Pranav said. So maybe I was not clear in my first answer that it is not as if I'm saying that just because it is OFS, it is bad, or 90s were great. I mean, the whole point is, as I said, that in 90s, there were years when there were 1,200 IPOs and 1,300 IPOs, and many of those companies have vanished. So today in the Indian markets, roughly 4,000 odd companies trade. The number of companies which have ever listed up to now, it would be at least 3 times that number. So, 2/3 of the companies that were ever listed have vanished from, or as I say, vanished into the blue yonder. They no longer trade. So that is the risk you run at times. And so it is not just that it is OFS and therefore it is bad, and if it was going to the company, it was all good. But except that when the money goes to the company, it is presumably utilized for something. So that's the That's the positive when it goes into the company.
Sure.
But that was not the only point.
No, fair.
The other thing, of course, I would like to caution investors is that the hype or the lack of hype for that matter in an IPO gives very little indication of how that stock will perform thereafter. So if you look at 3 years ago when all the so-called new age tech IPOs came, and I remember I was in a program like this and the anchor asked me that I would put a gun to your head, which one will you buy? Almost the same time around Diwali time 2021. And I said, gun to my head also, I wouldn't buy any of these at this valuation. But the other flip side, as I said, that when it is reasonably valued, then you don't get allotment.
Correct.
And also in terms of hype, of course, all of us remember that poster child like Reliance Power, where there was so much demand for the IPO and then the stock went to zero virtually.
That happens.
But
it's very real.
But I'm saying that's an extreme example. But let us take DLF, which did not, it wasn't as if there was any great disaster in the business.
Yes.
But for decades, IPO price did not come back.
Right.
Or for that matter, on the other side.
But is the size of the IPO an indication as well? Because frenzy is built around the big ones.
Yeah, but then you've had all these SME listings also, which unlike what Pranav was saying, it's not as if that the companies have reached a great position of corporate governance and only then they come from the IPO.
In fact, our research team has been doing this.
Yeah, let me also give you the flip side, which many of your viewers, because they are new in the market, will not know. And this I was listening to actually a financial journalist on a podcast, and he said maybe someone's parents were lucky enough to get an allotment in the Infosys IPO.
Right.
And I said, do you know that the Infosys IPO was undersubscribed? And it actually devolved on the underwriters, and the underwriters are the ones who made pots of money on that. So
right.
I'm saying both ways. How much demand there is for an IPO is not a very good thumb rule or a check for how the stock will do or whether the valuation is correct.
Pranav seems to be agreeing with that. He's nodding his head, saying that he probably agrees with this. But talking about how that frenzy builds up and how the stock performs on Dalal Street after listing, it's an important one to consider. So we got some context in from our research team, how some of their previous IPOs have performed. Many of the past high-profile IPOs, they failed to sustain the initial listing euphoria, just like Devina is pointing out. So let's go across to my colleague Jasmeet. He's joining us now on the show to give us that historical perspective. He's breaking down the reality of investors' returns from the mega IPOs that we've seen in recent times. Jasmeet, how does that picture look?
Well, right, yes, thank you for that. So we have combined data from last 5 years and gathered all the information stating the number of IPOs we have been getting year on year from last 5 years and the amount raised. Now, if you look at the figure from FY21 up until FY26, the IPOs are in the range of 53 to up until 65, while the FY25-26 figure are based in the month of September. The rest of the year is not been added. If you look at the fundraisers they have done, the highest has been in FY24-25, that's almost 1,62,000 odd crores, while the lowest in last 5 years would have been in FY22, which is roughly 52,000 odd crores. Let's quickly go across and find out the biggest IPO in each year and try to understand the return they have given on the listing day as well as the return they have given over the year as of today. Now, if you look at the year 2021, the biggest IPOs were Paytm, that's 197 Communication, as well as Zomato, which has given the listing day gain of 52% for Zomato, while for Paytm we had a listing day loss of 27%. And on the YTD basis, and as of today, we see that the Paytm is still at a minus 37% on performance, while the Zomato is booming at 166 odd percentage from the time of listing. Now, if you go at the next year, that's 2022, coming in the reverse order, the biggest IPOs were LIC and Delivery, again having a negative to flat return. But while we look at the return so far, it has been again flattish for LIC, but for Delivery, it's minus 14 odd percentage. Now, going ahead for 2023, the biggest IPOs for this particular year were Mankind Pharma and Tata Technologies. Given tech sector is been underperforming over FY26, we see that the stock is negative 41%, while if you look at the listing day gains, we're at 162% for Tata Technologies. On the other hand, for Mankind Pharma, a pharma stock, the listing day gains were high at 31%, while the gains for so far stands at 76 odd percentage. Now for FY24, if you look at the other sets of IPO, there's Hyundai Motor and Swiggy, again having a negative 7% while positive 7% return for Swiggy on the Y20 basis. As far today, from the day of listing, we see the performance of Hyundai Motor is nearly up 28%, given the GST cut acting positively on the back of it. On the other hand, Swiggy, we see it's flattish at minus 2%. Well, lastly, for FY25, so far we have two big IPOs, one of 12,500 crores at HDFC Financials, which gave a listing day before gains of 13%, given the big size. Even the gain is at 13%. On the so far basis, the stock has been minus 11% performance from the listing. If you look at the Hexaware Technologies, again an IT stock, if you look at the performance so far, is minus 15%, but the listing day gains are flattish at 7%. So this is the overall picture of last 5 years, the biggest IPOs in each year.
This really helps us understand, because look at the kind of listing gains that we see, and then eventually over the years how the stock performs. Does it really enthuse that kind of confidence in the kind of money that's put into IPOs? Pranav, what's your take? What's your sense? Because even right now, when you look at the hefty premiums in the unlisted markets on the IPOs that we are talking about, Tata Capital for one, we had a word again with Mr. Khemani, and he's saying it'll take investors at least 5 years to get there if they've kind of bought into the unlisted markets, this kind of frenzy that we are talking about. So it does take a while, doesn't it?
Yes, but before that, I would just want to make one clarification that when I was talking about governance standard, I was not referring to the SME IPO companies. I was referring to the PE-backed companies which are coming to the main board.
Okay.
Now, specifically talking about valuation, look, my view is that at what point in time do we take to look at the IPOs of a past period and pass a commentary about their valuation? Is it 3 months down the line, 6 months down the line, 5 years later, 10 years later? Ultimately, I believe that an IPO after the day of listing becomes like any of the 2,000, 3,000 listed companies which are there on the stock exchange, whose share price will go up and down on the basis of how the company is performing, how the sector is doing, how the economy is doing, how the broader markets are doing. And in fact, the data which you just put up as well exactly shows that it's a complete mixed bag. Some of them are trading way above issue price, while some of them have gone negative. The other aspect...
Yes, go ahead.
Yeah, the other aspect, so my view is that it's only on the day of listing, till the closing of the day of listing is when we should look at the issue price and make a judgment in terms of how the IPO was priced. And the reason behind this is very simple, that during an IPO, of course, as we know, there are several quotas, supply is limited, but on the day of listing, the shares become widely available for trading for all kinds of investors, retail, institutional, domestic, foreign, long investors, short investors, and hence there is some semblance of a price discovery. But beyond that, it just becomes like any of the listed companies. For example, if tomorrow there's an India-Pakistan war, would we expect all the IPO companies to not fall down, but all the other...
But Pranav, that's an extreme situation. Of course, the markets themselves on a large scale are going to feel the effects of something as big an event as the one you're talking about.
Yes, but the point is not, to talk specifically of that large event, but I'm saying that anything which happens in the broader market or broader economy will have an impact on this.
Sure.
So my view is that we should only look at the closing date. Even if we don't do that, actually the numbers show a very different picture. Even if I look at all the IPOs of the last 5 years, and look at the average return that they have given, you would be shocked at the figures. For example, for FY21 IPOs, the IPOs which came in 2020-21,
Paytm, Zomato,
the average return of all IPOs is at 270% till today. For FY22, it's at 107%. FY23, 102%.
Yes.
FY24, 54%. So on an average, actually, if you look at even the last 5-6 years, on an average, IPOs have returned a positive return till date.
Also, I want to ask Dhananjay, there are these 3 mega IPOs they were talking about. They're worth nearly 30,000 crore rupees, and all of them in 1 week. I also want to know from you, Dhananjay, do you think the market can absorb this much supply, or do you think it could suck out the liquidity in the secondary market? Dhananjay.
I think, of course, when there are primary issuances of large size, it actually absorbs liquidity. But I think broadly, the overall liquidity scenario sort of subsumes all the secondary market and primary market transactions. And I would say that in the current context, the liquidity going forward will be a most important thing. And I would say that liquidity might tighten from the current levels. I think the current level of buoyancy that we are seeing could be episodic. There is a sort of coming out of a sort of a correction phase, and there is a sort of a buoyancy that is there. So it's all clustered at this juncture.
Yes.
Broadly, I would say that what we need to really look at is the valuation, as we have discussed earlier. At the current level, it looks to be kind of stretched. So going forward,
so the timing is an important part of this, especially when you see the current condition of the markets. If the valuations are stretched, IPOs may have to be looked at differently. Devina, running out of time, but I want to ask you this. If you had to call it, is this IPO wave, the current one that we are talking about, is it a precursor to a bull market, or do you think it's a calm before a broader market consolidation?
I don't think we should link this to what will happen in the secondary market.
Okay.
Because, and if you look at all the examples that your research team showed, most of those, at least the mega IPOs that they mentioned, have not kept up with how the index has moved.
Right.
So that was quite clear from those examples, at least. I don't have the full data.
Yes.
So I would not say that, because the market itself has not, the secondary market has not run up so along with the IPO frenzy. So we can't say that if the the IPO frenzy kind of subsides, that means the secondary market would fall. Might well be, as you were saying, that some of it is actually taking out liquidity from the secondary market or the already listed shares market. So that is, that would be stretching it too far. But as I said, when there are frenzies, be careful. I mean, remember, Zomato came very early in 2021. The frenzy actually built up toward the end of calendar 2021.
Correct.
So that's why I'm saying when there is a frenzy, be super careful.
So be more careful is the word coming in from Devina on this. When there is that much more hype, that much more frenzy, you have to be that much more guarded as well. But this gives us a whirlwind kind of journey through India's IPO universe, from mega listings and this retail frenzy that we are talking about, the unlisted premiums, global investor sentiment as well is to be considered. But clearly the market is brimming with opportunity. We've heard today, liquidity, hype can sometimes blur fundamentals, but the facts of the fundamentals you cannot take away at this stage in our markets. But a big thank you. Devina Mehra, Pranav Haldia, Dhananjay Sinha, thank you for your sharp insights. You've helped us separate the signals from the noise. And our viewers, whether you're chasing the next big IPO, watching from the sidelines even, informed decisions remain your best ally. But that's it from us tonight. Keep an eye on the markets. We are going to see much more of you on The Big Question here on NDTV Profit. But for the moment, from me and the team, thank you and good evening.